We're now, as I look at my screen, 4,205. That's not gold rising, that's the dollar falling through the floor. And the rate at which it's doing it is now accelerating. I mean, we're looking at something so far this year, about 14,000 tons of silver. This is not an inconsequential. I mean, basically, the COMEX is now the largest silver mine in the world. There's a new licensing regime being put in place for silver exporters. Basically, they're going to make it harder for exporters to export silver outside China.
Gold and silver are not hitting record highs. Your money is hitting record lows. This is the analysis of economist Alasdair Macleod. He argues that from the moment the Bretton Woods system collapsed in 1971, governments were handed a blank check, a license for limitless spending paid for by quietly destroying the value of your currency. Macleod reveals that China is not creating a new BRICS currency. It is methodically building a gold-backed yuan, poised to replace the dollar for over 70% of the global population. At the same time, a silent crisis is locking in. Silver. China is shutting off exports. India's industrial revolution is consuming it. This isn't speculation. It's a physical shortage with no quick fix. Subscribe to Fine Metals for future updates.
The sequence of events, and it's going to drive the price of gold far higher, but it's not gold going up so much. It is the dollar and all the cohort of fiat currencies in their final death throes. I mean, that failed because the Americans were already running deficits. They were expanding, in effect, expanding the quantity of dollars in circulation, but more importantly, they were expanding it not so much in production, which had been the engine, if you like, for the post-war. And of course, what happens over the course of every fiat currency is it's a license for the ruler or the government to spend, 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 spend. And you devalue the currency, you debauch the currency, and eventually, and this is the key to the ending of the fiat currency system, people begin to lose faith in its value. The disparity in terms of valuation of the equity market, I mean, talking American equities here, is greater than it has ever been in history. We don't have statistics for, or at least I haven't managed to achieve statistics for 1929, but I would guess it's worse than that. It's certainly considerably worse than the dot-com bubble. Now, we've had the first surge. We've had a consolidation in bond yields from about 2022. That now looks like it's changing. If you look at the JGBs, they've started soaring. Look at the German Bund, the 10-year and even longer ones. They're looking like breaking out into new high ground. There are various sort of bond markets like that indicating that things are coming really to a close, if you like, in the sense of bond yields consolidating before they move higher. And when they move higher, that's the bit that breaks the equity bubble. So those are the two things to look for. I mean, the equity bubble could well burst without those bond yields moving higher first. We don't know. I mean, there's so many things around which could trip it up, but those are the two principal things I think you've got to look at. Well, they've already started with, well, I mean, they will have next month, already started with QE. They've gone from QT, which they've dropped. They're going into QE. What that basically means is that the Fed will be in there buying assets for cash in the form of base money, if you like. I mean, particularly in the form of adding to bank deposits. QE, we're going to see QE like they've never done before. What you're going to get is you're going to get the gold price rising because the gold price is going to tell you, oops, there's going to be huge, great inflationary consequences of this. China will effectively replace the dollar for nations representing over 70% of the world's population. That is the consequence of the currency destruction. The Shanghai Gold Exchange opens vaults in Hong Kong and also in Saudi Arabia. Saudi Arabia being, the biggest oil supplier or energy supplier. And I have no doubt that the Chinese have been talking to other, if you like, the nations where the Chinese diaspora is around Southeast Asia, saying, right, we will happily exchange yuan for gold or whatever. So you can take yuan in the knowledge that it'll be exchangeable in gold. That is the whole point about opening SGE vaults outside China. What China does not want to do is to be blamed for the collapse of the Western financial system. So she will go along with it to the point where she feels she's got no option but to protect her own currency by fixing an exchange rate between the yuan and gold. And we are looking at trade for the whole of the Shanghai Cooperation Organization. We're looking for the whole of BRICS and all the rest of it. I mean, the idea that, the unit which has been promoted, forget it. That's a nonsense, absolute nonsense.
The core argument is that we are witnessing a monetary collapse, not a commodity boom. The end of the gold standard in 1971 enabled rampant money creation, devaluing currencies. The impending burst of the historic stock bubble will force a catastrophic new wave of printing. Simultaneously, the global financial system is shifting, with China establishing a gold-backed yuan to challenge the dollar, while a critical physical shortage in silver emerges due to geopolitical and industrial pressures. This confluence signals the terminal phase for unbacked paper money.
It was the currency collapsing which did it. And of course, they continue to collapse the currency after the revolution. And then they replace it with another fiat currency, which, the mandat territorio, pardon my French pronunciation, which again collapsed. So, the role of a fiat currency, the end of a fiat currency, is something that doesn't happen easily. It really doesn't. The consequences are likely to be, really horrid. And so when it broke down in 1971, that was just part of a process, if you like, of currency destruction. It was quite clear to the US Treasury, et cetera, that in 1971, the run on the US Treasury's gold stocks by foreign governments was going to threaten the whole system. So they had to suspend it. Note the term suspend.
Depends, yeah.
Yeah. Still suspended 54 years later. You find that the final move in an equity market occurs when things are looking good in the economy and there is demand for credit. And the result is that bond yields have begun to rise to reflect that demand for credit. So you get, for a brief period of time, you get this sort of markets moving in sync, as it were. Then you will get a pause because obviously things get a bit overheated in the economy, interest rates have risen a bit and all the rest of it. So things sort of pause, if you like, in the bonds. But in equity markets, they probably continue rising. The problem then is that bond markets begin to reflect risk because the economy is actually going towards into recession as a result of the higher interest rates, et cetera, et cetera. I think not. I think the way in which this will pan out is that, first of all, you will get an equity market crack, as it were. Now, whether it takes 3 years, as it did between 1929 and 1932, or whether it takes 10 minutes, only time will tell. But when that happens, bear in mind that there is an awful lot of bank lending on the back of collateral in the form of stocks and shares. And that, as that collateral value starts declining, the banks will basically liquidate those positions. So you'll get a falling market with banks liquidating the positions. On top of that, you've got another problem. And that is that according to the US Treasury's tick figures, foreigners own over 20 trillion of US equities. And that's part of a total of 44 trillion of dollar deposits, short-term debt, and also long-term debt, including US Treasuries. But half of that, roughly, just less than half of that, 20 trillion, is invested in equities. Now, we know what foreigners do when a market goes sour on them. They get the hell out. Now, I don't think they'll realize 20 trillion. They might, if they're lucky, realize five as the whole thing falls down around their ears, of the whole thing falling over. Those are the two things to look at, Jan. I think you're looking, you've got to look at where interest rates are going, where bond yields are going. I mean, interest rates, short-term interest rates, the Fed has decided that it's going to, things are getting so bad, we've got to support the economy, we've got to ensure there's sufficient liquidity, et cetera, et cetera. So we're going to get a cut on Wednesday. I mean, that's a given. Meanwhile, of course, the carry trade is financed out of yen, and guess where that's going? I mean, interest rates in Japan are rising, and if you look at the yield on the 10-year JGB, I mean, that's now close to 2%. So you've got, two problems there. I mean, the Japanese institutions, who are the largest foreign holders of US treasuries, no longer have the incentive to buy US treasuries because, I mean, the reason they bought US treasuries is because their own bond markets yield the square root of nothing. That's now changing. And then you've got the carry trade as well, which is being run basically by hedge funds out of the Cayman Islands and also out of Luxembourg. So, that arithmetic is beginning to go awry as well. So interesting times, interesting times. Just plan long term and try and avoid the risk of something happening suddenly. I mean, if you think back to the Lehman crisis, it could all have fallen apart then. But what the Fed did was it came to the rescue. It effectively wrote an open-ended commitment, which I reckoned at the time was about 13 or 14 trillion dollars. Now, that was a lot of money at the time. I know trillion isn't so much now, but
Not real on that.
this is huge. Yeah, I mean, absolutely huge. Now, this time, it's got to be even larger, and it's just going to debauch the currency. It's as simple as that. The narrative is it's got nothing to do with the quantity of credit or whatever. It's all to do with those nasty capitalists, demanding higher prices for their goods, sort of thing. And that narrative is the one which everybody understands. It's wrong, but that's what they believe. Um, and of course, the first people to realize that a currency is overvalued are the foreigners, and they're the first to sell it. You will find also that a few enlightened investors, I mean, generally, let's say old money, let's say, big family offices, let's say some of the smarter institutions will see this and they will hedge out of it. Um, but basically, all the language about what inflation is just totally wrong, and it's misleading everybody. So the public just don't understand what is going on until very, very late in the game. Then you will get the rush. I mean, the Austrian economists called it the if you like the crack up boom. Whereby at the last moment, the dying moment of a currency, when people realize that it is the currency going down and not prices rising, what they do is they get rid of all the currency they've got to get into goods before the currency actually finally collapses. And that's the sort of, if you like, the crack up boom, which marks the end of any credit value in a currency. So people are going to suffer from this, I'm afraid, and they will learn the lesson late. I mean, part of what you're doing and what I'm doing is to try and educate people about these factors and save them, if you like, from all the propaganda, the wrong propaganda that the establishment has put out about, the value of the currency and all the rest of it. But basically, as you draw down on a loan, you've still got the asset there, but if the drawdown is paid away from the bank, in other words, it's paid to someone who doesn't have an account in the bank, then the bank has to go into the interbank market in order to make up the difference. So, but I mean, long experience going all the way back to the goldsmiths has showed that it's very unusual for a bank's balance sheet, assuming you've got a spread of customers, to vary by more than 3% on the deposit side. So that's all you've got to make up at the end of the day. Now, obviously, This all depends on the creditworthiness of the bank. If you get worried about people start getting worried about the bank, you get what's called a run on the bank, and then that sort of 3% figure goes out of the window. But when it comes to tether, I mean, tether units of tether are created, if you like, by demand from the public, and this is generally to deal in cryptocurrencies. Then what happens is that tether, if you like, has a credit, as it were, which it can then apply onto the asset side of its balance sheet. So it will go and invest in US Treasuries, mainly short-term US Treasuries. Now, the point about the Genius Act was to ensure that that was channeled into short-term Treasuries. But interestingly, Rick Rule in an interview the other day said, he's met the guys on the dealers in Tether, and he said they're all gold bugs. Which might explain why suddenly they've got 112 tons or 115 tons of gold.